Do you want to know how you can lower your taxes by using a traditional IRA? Now, some of you may think this is quite easy, but it may not be as simple as you think. But we're going to be talking about that today in our Tuesday tips, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center. And I want to welcome you once again to our Tuesday tips, where we're going to be talking about how you can perhaps lower your taxes by utilizing a traditional IRA. Now, I am going to tell you, as a certified financial planner, I absolutely understand how confusing the retirement landscape may be. And of course, the rules are always changing, and you're going to have to understand how these rules may apply to you. And I can tell you that if you're not getting professional help, you can really become very confused about all of these different rules that may apply when it comes to these retirement vehicles. So today we are going to be talking about how you can lower taxes with a traditional IRA. So let's just go ahead and jump into our lesson. First, it's always key that I point out the mechanics of a traditional IRA when we're talking about these types of accounts. One of the things you must understand is that the earnings inside of a traditional IRA is going to grow tax deferred. And when you pull money out of these accounts, that money will come out at your ordinary income tax bracket. So you do have to pay taxes on the back end. Also, it's need to be understood that if you take money out of a traditional IRA before the age of 59 and a half, you may incur a 10% premature distribution penalty. So you need to really make sure that if you're taking money out of these accounts, it's for a qualified reason so you can avoid this. But beyond that, you will have to pay a 10% early withdrawal penalty if you take money out of these types of accounts before the age of 59 and a half. Another thing that you must take note of is that you can only make contributions to a traditional IRA if you have earned income. So if you're retired or if you're in between jobs and you're not earning an income, you cannot contribute money to a traditional IRA. You also need to know that if you have these types of accounts and you have turned the age of 73, you are mandated to take money out of these accounts. This is known as required minimum distributions. You have to take this money out by April 1st of the year after you turn the age of 73. So if you turn 73 this year, by 2025, you do have to have those distributions out of that account by April 1st. Because if you do not take those dollars out at the appropriate time, there could be a distribution penalty of up to 25%. So it is in your best interest to make sure you're speaking with your advisor to help you get these distributions out of your account in a timely manner. Now, when it comes to trying to lower taxes with your traditional IRAs, it is important for you to understand there are two types of traditional IRA categories, okay? These two traditional IRA categories would be a traditional deductible IRA and a traditional non-deductible IRA. We're going to explain the differences here. With a traditional deductible IRA, any contributions that you make to that particular type of an account, you can deduct it off of your taxes. For example, if you had income of $50,000 per year and you were to put in $7,000, which is the maximum amount in 2024 if you're under the age of 50, into a deductible IRA, your income that you would have to claim for that year will only be $43,000. You will get a tax deduction of that $7,000 that you put into this particular type of IRA. Now let's talk about a traditional non-deductible IRA. Now in this particular situation, the contributions are not deductible. Any distributions of deferred earnings will be taxed at your ordinary income tax bracket, but any contributions that you put in will not be taxed. So let's go ahead and take a look at the second example here. Let's say you put $7,000, but it went into a non-deductible IRA. Now, when you went to take money out of this traditional IRA, the value had grown to $7,500. The $7,000 you can pull out and there won't be any taxes associated with those funds, but the $500 that you did earn on the account, that money will be taxed at your ordinary income tax bracket. So again, I want to point out in 2024, the maximum contributions that you can put into a traditional IRA is $7,000 if you're under the age of 50, or $8,000 if you're 50 and older, because they allow you to put in an additional $1,000 as a catch-up clause. Now, when it comes to trying to lower your taxes with a traditional IRA, it's not as easy as it might seem, because there is this thing known as a phase out of your deductibility of that traditional IRA funding. Now, with that being said, if you are not covered by a work plan from an employer, so that means that you're not covered by a 401k or 403b, and you're not contributing to those types of accounts, any money, no matter what your income level is, you can put into a traditional IRA, and that money can be written off on your taxes if you're not covered by a workplace plan. But as you know, millions of people are covered by workplace plans. So that's what we're going to talk about today as it pertains to a traditional IRA and the ability to lower your taxes. So in 2024, that's what we're going to be covering here. So what we're going to be looking at today is that if you are married and both of you are contributing to a 401k plan or an employer-sponsored plan, and if you are married, if only one of you are contributing to an employer-sponsored plan, we're going to see how this may play out on how you can lower taxes with a traditional IRA. So first of all, let's take a look at a single filer. Now, with a single filer, there is no spouse. So if you are a single filer and you are covered by workplace plans, these are the rules that are going to apply to you. In 2024, if you have income that's less than $77,000, any money that you put into that traditional IRA, you can also write off on your taxes. So if you put money into a 401k and you put money into a traditional IRA, and you make less than $77,000, you can write off the amount of money that you contributed to that IRA. Now, between income of $77,000 and $87,000, there is a phase out amount of what you can actually deduct from your taxes. So that phase out amount, depending on the income between this amount, could be maybe only 50% of it. It can be only 20% of it. But with that being said, if you do have income between this amount, just know that you cannot deduct all of that money from that traditional IRA that you contributed. Now, if you make over $87,000 as a single filer, you cannot deduct any money from that traditional IRA that you put in. If you're contributing to a workplace plan and you make over $87,000, you cannot deduct any of the money. So just keep that in mind. If you're married filing jointly, the same rules do apply, but just at higher income levels. If you make less than $123,000 and both you and your spouse contribute to a workplace plan, you can still deduct the money that you put inside of your IRAs. So if you put $7,000 and your spouse were to put $7,000, you can literally deduct $14,000 from your taxes by contributing to a traditional IRA. But just like a single filer, if you have income between 123 and 143, there's only a percentage that you can deduct from the amount of money that you put into that traditional IRA. And if you so happen to have household income above $143,000, no matter what money you put into that traditional IRA, it cannot be deducted from your taxes. So now let's transition over here that if only one of you as a married couple will be contributing to an employer-sponsored plan. In this situation, the participating spouse, the person that's actually contributing to the employer-sponsored plan, the income levels are no different than when both of you are contributing to an employer-sponsored plan. The income levels are exactly the same and the rules are exactly the same for you. But for the non-participating spouse, the spouse that is not contributing to a 401k, the income levels are higher. So if the household income happens to be below $230,000, then the non-participating spouse could still deduct all of those contributions from their IRA. Now, between 230 and 240, there is still a phase-out period for that non-participating spouse. And if the household income is above $240,000 for the non-participating spouse, and of course the spouse that were participating, no one in the household could actually contribute to an IRA and deduct it from the taxes. These are the rules, and I know they're very confusing, but that is why we implore you on this channel to always seek out competent advice when it comes to you and the funding of these types of accounts. So the one thing that I will leave you with, that if you do make too much money, there are options for you, of course. You can fund a non-deductible IRA and then subsequently convert that non-deductible IRA into a Roth IRA. At that point, you can then enjoy tax-free growth, and you can also enjoy tax-free distributions from that Roth IRA in the future. So this may be an option for individuals who cannot put money into a traditional IRA and write that off on their taxes. They could just put that money into a traditional IRA and then convert it to a Roth IRA. And then, of course, reap the benefits on the back end of their retirement. Thank you again for tuning in to our Tuesday tips. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. And of course, we will always like to hear from you. Let us know about what your understanding may be when it comes to utilizing a traditional IRA. Have you ever made a mistake of contributing to a traditional IRA, thinking that you could write it off on your taxes, later to find out that you couldn't? If so, please share any of your comments in the comment section below. And if you found this information to be beneficial, all that we ask is that you subscribe to our channel so it can continue to grow. Like this video and share with others.